Perhaps the most noteworthy event of the month was the Federal Open Market Committee meeting, where the Federal Reserve left interest rates unchanged at the target range of 5.25% and 5%. However, there were a lot of noteworthy forecast revisions worth noting. So we saw that growth projections were lifted materially throughout the forecast horizon, which is certainly encouraging. However, we did see that core personal consumption expenditure price index also lifted to 2.6% this year from 2.4% previously forecast. This is particularly important because with rising demand, we have seen inflation, at least in the last two prints in particular, from a CPI perspective, surprise to the upside relative to market expectations. So what we also saw was the outer years in terms of the federal funds rate forecast upwardly revised, hinting at a shallower cutting cycle for the Fed. However, the market took a lot of comfort in the fact that the Fed are still signaling 3 rate cuts this year in 25 basis point increments, hence the rally on the day. In other major central bank developments, we saw that the Bank of Japan hiked the interest rate for the first time since 2007. So they ended their period of negative interest rates, voting 7-2 to hike the rate to a range of 0% to 0.1%. There were also some noteworthy developments in terms of other central bank actions that took place. So the Bank of Japan is also committed to ending real estate investment trust purchases. They're also committed to ending exchange rate trade fund purchases. However, at this juncture, they're still buying corporate bonds, and they did hint at further dovish intent that they will still intervene in the market, particularly the fixed income market, if need be, if we see an undesirable increase in yields, for example. So we saw market participants take a lot of comfort in the fact that the yen continued to depreciate on this dovish rhetoric. In other interesting developments, we saw that Chinese authorities released a lot of their targets for 2024. So their growth target for this year is still aimed at 5%, so that is unchanged from last year. However, they have a shallower fiscal deficit target of only 3%. So this really suggests that a lot of the stimulus to even achieve the 5% target is likely to take place from elsewhere. So we have already seen from a monetary policy perspective a lot has been done, such as cuts in reserve requirement ratios, which have freed up liquidity for small and large banks to be able to lend more. We've seen a deep cut in the 5-year loan key prime rate, which is the key rate that is followed for housing to re-stimulate the property sector. And really what we want to see is confidence being restored into the Chinese economy and less haphazard policy pronouncements, really to foster that confidence, foster growth, and move into a much more sustainable cyclical and hopefully structural recovery. The other targets that were in place were little changed from previous years. So these were the primary developments in terms of their growth and fiscal deficit targets, suggesting again that not a lot of stimulus is going to take place on the fiscal front. To wrap up, one thing we watch quite closely is financial conditions globally, with a particular focus on the United States. So we've seen traditional risk metric spreads like the bond market and money market indicators compress. So if you look at things, for example, like your Treasury Euro dollar spread or your Treasury to high yield spread, for example, in the fixed income market, these things have meaningfully narrowed, indicating a less perceived level of risk in the market. However, going forward, we're always looking for a perverse result of these metrics to turn, and if liquidity is still going to continue to be plentiful. So we are heading into tax season this month with a lot of tax receipts still expected from the TGA account going forward. So we will monitor developments in terms of the liquidity impulse quite closely, and we'll look for a perverse effect in terms of asset market directionality.